Sold business profit, a guide to tax efficiency. It might be difficult to plan a business sale. Here are the tax repercussions of selling a business in Australia that you need to be aware of. Determining tax obligations is complicated in nature. Engaging with the services of a professional tax advisor is your best option to optimize your tax situation. Tax rates for business sales in Australia reach as high as 49%. Ensuring the worth of the business and receiving the fair value for their hard work is the primary focus of business owners when selling their business. How are tax rates determined when selling your business? The sale of a business is typically included in the business income and is taxed under the specific tax rate of your business structure. The two most commonly sold business structures in Australia are sole traders and trusts or company structures. Tax rate from high individual tax brackets depending on the sale price of the sold business. Sole traders and trust. Taxable income. Tax rate: $90,001 to $180,000. $20,797 plus 37% on every dollar, over $90,000, in addition to a 2% Medicare levy. $180,000 and above, $54.097 plus 45% on every dollar over $180,000 in addition to a 2% Medicare levy. Company sale tax rates are calculated in a different manner. The company structure's sale tax in Australia is typically taxed at a nominal tax rate between 25%–30% owing to the base entity rules. What is your capital gains tax, CGT? In Australia, the sale of a business regardless of the business structure is considered as the sale of an asset. The profit generated on the sale of an asset is subjected to capital gains tax. Business sale capital gains tax amount depends on these factors. The sale price of the business. The initial cost of establishing the business, cost base. The business structure. Any tax concessions that the business is eligible for. Businesses that have an annual turnover of less than $2 million or hold net assets less than $6 million are considered as a small business that can benefit from a variety of tax concessions. Business sale capital gain tax concessions under the SBCGT regime. 50% capital gains tax reduction, business owned for over a year. 50% active asset capital gains tax reduction, the sale of an active asset. 15-year capital gains tax exemption, business owners over age 55 and owned the business for 15 years. Retirement exemption, business owners over age 55 allows to ignore up to $500,000. Asset sale versus share sale. Asset sale is the sale of the assets held by a business which includes property, land, equipment, or stock, and still retains the ownership over the legal entity of the company. While share sale means the share of the company are sold to the buyer, which gives ownership over the company to the buyer. Key point: the most crucial component of any business sale tax strategy is forward planning. Business owners must approach the sales process with meticulous planning and careful consideration of the consequences of their organizational structure.